Thank you. Good morning. Good morning, everyone. Today I'm going to talk about three kinds of money. Because over the past 12 years, I've been presenting about Bitcoin to a variety of audience. And I came to the conclusion that it's easier to talk about why Bitcoin exists, and why it will coexist, by the way, with other forms of money, rather than explaining how it works. I started by explaining how it works, but I quickly realized that first there were lots of online resources that you could find to find out, do your own research, and find out how Bitcoin works and how other cryptocurrencies work. But the why is, in my view, much more important than the how as far as cryptocurrencies are concerned. So I came to the conclusion that there are three forms of money. Proof of work money, which is obviously Bitcoin, if you know a little bit about Bitcoin. Proof of stake, which is basically what the foundation for most other cryptocurrencies protocols. And last but not least, pledge of work. Pledge of work is an expression I coined after using fiat money for a very long time. I wasn't happy with fiat money because it sounds old and it gives the impression that it's a different kind of money. In fact, in my view, traditional money like euro, dollar, Swiss franc, are all cryptocurrencies. They just use different protocols and different governance. Basically, they have a master node with it's the central bank, and they have second-tier nodes like commercial banks. But essentially, they run as a network. And that network is powered by cryptography, just like any other cryptocurrency network. So there is no reason to set them apart and call them fiat money. It's just pledge of work, and I'll explain why it's pledge of work, and we'll talk about proof of work and proof of stake also. I conclude with proof of stake. So next. So my background is engineering and cryptography. I've been in it for quite some time, as you can guess. The first large-scale application of cryptography was not money, it was digital television. So I came in contact with cryptography through by working on various digital television projects in the 90s and in the early 2000s. And then obviously I ran into Bitcoin as a result of my watch over the cryptography field in 2008, 2009. So pledge money is money as we know it before the invention of Bitcoin. Why pledge of work? Because the protocol involves, for issuing new money in pledge money protocol is the issuance of credit. So there is a borrower. Someone is borrowing money from the bank, and that creates money out of thin air. Actually, it's not really ex nihilo. It's not really out of thin air because there is a energy counterparty to the creation of money. And that energy is coming from the borrower. He's pledging to work to repay the loan. That's his pledge, her pledge. And that's why I call them pledge money or pledge of work. So it's future energy, and that's why it's essentially money that's in unlimited supply. It's impossible to put a cap on this kind of money because obviously pledges can be made without limit. There are limits. There are prudential ratios applied by the banks, but these limits are very loose. And what we observe is that the amount of money circulating in the economy is ever increasing. So how does it work? It's like magic. Right before Bob signs the loan agreement, the books are in a given state, the accounting books are in a given state. Right after he signed them, he signed the loan agreement, the bank makes a book entry, and all of a sudden, its book on the asset side has increased by 10,000, if that's the amount of the loan. And at the same time, Bob's account balance has increased by 10,000. And that's new money because the bank didn't have the money before Bob signed the loan agreement. So that's a book entry, and that's why it's called fiat money sometimes, because it's created with a keyboard stroke, basically. So that's issuance of credits. That's a money creation transaction in a pledge of work protocol. So that's, again, money as we know it. So not everybody can do it, because you have to be part of the network. You have to be an authorized node. It's not a permissionless network. It's a permission network. So to be on board of this network, to be able to create money, you have to have the license. So that's the gatekeeping toll, if you will. So you have to go to the central bank and get the license. And then you can create money out of thin air. Again, it's not really out of thin air, because there is energy, and the energy is that of the borrower. There is also an interesting transaction. It's every time Bob repays, each month he will repay some of the loan principal. And that's a destruction of money. In the cryptocurrency language, we call it a burn transaction, because that money is taken from his account and from the bank's balance sheet. And as a result, that money is taken out of the circulating supply. So that's a burn transaction. So in effect, loans are issued in much greater quantity than installments are paid. And as a result, the quantity of money that's circulating is ever increasing. If you look at the charts, you can see it. And that's also the cause of inflation. Again, in a peer-to-peer loan, just for fun, there is no money creation. You are just transferring money from Alice, the lender, to Bob, the borrower. But Alice has to have the money on her account before she can lend it to Bob. That's the main difference. That's the key difference between the bank and you and me. So that's a peer-to-peer loan, no money creation. In the case of a peer-to-peer loan, it's legitimate to ask interest, because Alice is renouncing the usage of the money. She's lending it to Bob, just like she would lend her car or her apartment to Bob. So it's quite normal that Bob pays some kind of rental fee for the money. In the case of the bank, it's less clear. It's less clear, and some people are questioning the fact that banks apply interest on loans. Some people say there should be only, issuance fee, transaction fee, but not percentage-based fee. That's a question I can leave to your reflection. So that's how pledge of work protocol works. Now, let's talk about Bitcoin and proof of work for a little bit. Obviously, now you start to understand that there is a link between money and energy. Money is a representation of energy, because when you work, you get paid with money. You accept money as compensation for your work. That means money is equivalent to energy, to your energy. So it's a form of energy, of a representation of it. It's information. It's what we call in physics, it's information. Information represents energy. I can give you another example of information. It's GPS information coming to your smartphone if you use Google Maps or Waves or this kind of application. You receive information on your phone, and that saves you energy. It saves you to get lost in the city or in the wild. So it's equivalent to energy. Information is equivalent to energy. It's just a representation of it. It's what in physics we call entropy. Entropy is actually lack of information, but you get the idea. So now, let's look at some numbers. I'm an engineer, so I like to look at the facts. Engineers are known to like to find solutions to problems. That's what we do for a living. But also we have to focus on the facts, because otherwise our solutions are out of whack. So Bitcoin consumption, you hear about it all the time. right? It's a big problem, major problem. It's kind of the key problem of climate change is Bitcoin consumption. Well, in fact, it's anywhere between 100 and 150 terawatt hour per year. That's the total amount of energy, electricity, used by Bitcoin. I tend to stay away from consumption, because consumption gives you the idea that energy somehow can disappear. And that's against the law of physics. Energy can only be transformed, cannot be destroyed, cannot be created. It has no end, no beginning. So energy is only transformed. I like to use instead energy usage instead of energy consumption. So each time you see the word energy consumption, you can start to think about what, in fact, it's in fact a transformation of energy. So gold is consuming also, using a lot of energy for mining. But obviously, it's not the same energy. You all realize it's very different. It's mostly fossil energy. And it's also using up lots of land and destroying forests, polluting rivers, etc. So gold mining is very, very detrimental to the environment. And it uses even more energy than Bitcoin. Strangely, you don't hear a lot about gold mining as a problem for the environment. Strange, right? You have to dig for the information. So the banking system. So I put 260 terawatt hour per year. That's the approximate number for the network, the cooling system, IT systems, etc., offices. It's about the same as any network deployed on a global scale. You can think of Facebook or Twitter or these kind of networks. They will all use around 250 terawatt hour per year, roughly speaking. But there is one big thing that's forgotten about the cost, the energy cost of the banking system. It's the number of jobs that are entailed in running it. And that's about 45 million jobs, full-time employees on a global basis. In France alone, it's around 400,000 employees. So the global number is between 45 million and 50 million. And it turns out that every person on Earth, on average, and I insist on average, we use 20 megawatt hour per year. That is, in the US, they will use 60 megawatt hour per year per person. In France, it's around 30, 35. In Africa, it's anywhere between 10 and 20. But the average is 20, okay? So if I take the average of these 45 million jobs, I end up with a number around 900 terawatt hour per year. So you can tell me, well, this is the food these people consume, they commute to work, etc. It's not really the banking system itself, right? Well, it's called in economy an opportunity cost, because this energy is actually used by these people, but these people could do something else. Because Bitcoin runs with a few thousand people. So it's a form of artificial intelligence, if you will, that will potentially allow us to reallocate resources to other activities, more productive activities than keeping accounts or doing the job of a central bank. And evidently, if we use this gauge to evaluate the energy use of each system, the picture is vastly different from what we are told usually, right? So again, that's one thing, that's food for thought. You can make your own opinion based on these facts, but they are facts. So that's just an explanation of what I just said. The other thing to bear in mind is that the energy used by the banking system is premium energy. It's competing with other usage of energy in the cities, wherever there is a data center, etc. Whereas Bitcoin mining, specifically by virtue of the protocol, incentivizes miners to go for the cheapest electricity. And the cheapest electricity you can find is surplus electricity. In other words, if as soon as a Bitcoin miner is facing competition for access to electricity, he will move. Mining gears are in containers, and these people move their containers to wherever electricity is the cheapest. There are all sorts of energy surpluses. I studied energy production for the past 10 years because I was always asked about energy usage by Bitcoin. So I had to look for data and information. It turns out electricity production creates lots of surpluses because in renewables, obviously, the supply is constantly changing. It's the wind and the sun. To some extent, the water is relatively changing, and the demand is also changing all the time. From peak hour in the morning and in the evening, and tide in the midday. So the demand is constantly shifting, supply is constantly shifting, and as a result, there are lots of surpluses that electricity providers have to face. And it's a real issue they face that they call grid balancing. So they have to have customers like Bitcoin miners that allow them to balance the demand side of this complex equation. So as a result, lots of surpluses in renewable energies. So in a sense, by monetizing surplus energy, Bitcoin is favoring investments in renewables because it removes the pain point in renewables, which is the balancing of the demand side. And there is also another big topic for the environment, which is methane, flare methane. That is the gas, natural gas that's released by oil rigs, etc. The GIEC has identified it as one of the key problems to solve for climate change, prevention of climate change. And Bitcoin also helps with this issue because Bitcoin miners can come in and use that excess methane, if you will, that's unused, that there is no conduct to move that gas, so it's released in the atmosphere. Methane is about 80 times more powerful as greenhouse, in terms of greenhouse effect. It's 80 times more powerful than CO2. Methane is very, very bad for the greenhouse effect. So it's better to transform methane to CO2, and that's exactly what Bitcoin miners do in some places of the world where there is excess methane or methane that people release in the atmosphere. So again, to me, that's a rather positive impact on the environment. So contrary to some propaganda, and I will not point the finger at anyone here, there are benefits to supporting Bitcoin mining for the environment. And again, when we compare energy usage, we have to ask ourselves, what is the energy that's being used? There are another advantage of, obviously, of these other protocols that we'll talk about now, proof of stake and proof of work. That is, they put an end to the monopoly. And the monopoly, in general, is not very good. It's not good for quality of service, and it gives a lot of power to a few people. So in general, I think the end of a monopoly is a good thing, and it's good for money as well. So we'll see how it turns out in the law, but in reality, it's already ended. Also, the other problem that Bitcoin can solve is unlimited money supply. I don't know if you can solve it, by the way, just a different system so will not allow unlimited money creation. But clearly, unlimited money creation has its drawbacks. It's very handy for social welfare and all sorts of valuable objectives. But it has also some major drawbacks that I listed here, but I guess you get the idea. So proof of stake, I talked about proof of work just now. So proof of stake is an interesting hybrid between pledge of work and proof of work. Basically, it's proof of work without the work. It's a proof, it's a mathematical proof, just like proof of work. But the only proof is a signature, and the energy usage for generating a signature is very low, it's negligible. So essentially, you take a proof of work protocol, you remove the energy usage, and you have proof of stake. And I will use two analogies to help you understand the difference between the two, because I see a lot of confusion about this subject. Some people come claiming that it's a miracle solution because all of a sudden it doesn't use any energy, so it's good because it doesn't use any energy. It's not so simple, because as I presented before in the slides before, energy usage in Bitcoin is kind of virtuous for the environment, in fact. But you could claim it's interesting to have a system without any energy counterparty for money creation. So it's an interesting hybrid. It helps to draw a lot of people to cryptocurrencies, so I think it's a positive. But it's not the same. Why it's not the same, I will try to explain in these two slides. So those are my last two slides. Those are the last two slides before the break, so I will conclude quickly. Proof of stake is a signature, as I said. The value of this painting, the Jackson Pollock painting, is comparable to the other painting there, a 19th century painting by a classical painter named Ingres at the Louvre. So we have two examples of very valuable paintings. The only thing, the value of that painting is coming almost exclusively from the signature of this guy, Jackson Pollock. If my 5-year-old son does it, it doesn't have the same value. He can do it also, but it doesn't have the same value as Jackson Pollock, because that's the signature of Jackson Pollock that makes it valuable. It's pretty much the idea of proof of stake. It's valuable because they are trusted stakers. We trust that they will not game the system because they have a stake in it. That's the word stake. Except it's a kind of circular logic because the stake is in the currency that they are supposed to protect. They're supposed to protect the value of that currency. So it's kind of circular logic. Because the problem, you see immediately the problem with that. It's because they can stake as many proof of stake systems they want because there is no cost in staking those coins, except acquiring the stocks, the coins. But they are airdropped. so there is no cost in most cases. So again, it's a word of caution. Proof of stake coins come in unlimited supply by design. Why? Because there is no energy counterparty. There is no mining gear to be purchased. As a result, I can stake all these coins in parallel without any additional cost, practically without any incremental cost, except the disk storage to store the blockchain. So it's a negligible cost compared to proof of work mining. So you get the idea. Proof of stake is interesting, but don't forget it's unlimited supply. Not even if a given coin says or claims it's in unlimited supply, it's in competition with tons of other proof of stake coins. So as a whole, proof of stake coins are in unlimited supply by design. Again, because no energy counterparty. It's not the same with proof of work because here I have to spend energy to create the proof. So I cannot fake the proof, it's verifiable, and I cannot produce it for nothing. So I can, if I set a limit like Bitcoin does, it's a true limit, it's enforceable, because to break the limit, you have to spend energy. There is a physical barrier to breaking the limit. So the other analogy I can take is the sealed envelope compared to the vaults. Sealed envelope is tamper evident. If it's tampered with, I can see it immediately. It's been opened, it's been tampered with. I can verify the signature. All that is proof of stake. It's verifiable, it's trusted, but it's nowhere near the security of a vault. Because the vault, I need energy to break into the vault. I have to have the key, but if I want to break into it, I have to spend energy to break into it. There is a physical barrier. So it's the difference between tamper evident and tamper resistant. Okay, so if you can just get these two ideas about proof of work, proof of stake, you understand the difference, and then you can make your decisions as to if you want to invest in such and such coins. I'm not recommending either one here. I'm just saying they are different animals. And that concludes my presentation here. I'd be happy to take questions. Again, we run an exchange at Paymium, and we've introduced proof of stake coins, so we are not exclusively Bitcoin. We've been Bitcoin for a long time, but in around 2018, we added altcoins because we see it as a way to attract more people to the space. And so we are supportive of Ethereum and Ethereum tokens. Don't get me wrong, I'm not advocating a form of money over there. These three kinds of money, pledge of work, proof of stake, are the ones that can categorize the money as we know it in 2023. And I hope that's a helpful framework for you to think about it. Again, I'd be happy to chat after the presentation. Thank you very much for your attention.